The strong dollar might be here to stay as war and uncertainty in Europe and the UK abroad make the USA a comparatively better place to invest. This plus a spendy consumer here at home could mean inflation is set to remain higher for longer. For more, let's bring in Joseph Lewis, who is the Jefferies head of corporate hedging and FX solutions. Joe, great to have you here with us today. First and foremost, we've already heard a lot of tech companies especially really give their insight or at least forecast into how much FX headwinds would continue to impact them. Is it going to be in par or in line with or even greater than what they anticipated?
So first things to remember about companies and how they think about foreign exchange is that it's an averaging process, right? So what you see immediately today will take some time to flow through their earnings. I think what you'll expect is that if the dollar continues to be strong, which is generally the expectation, you're going to see this show up probably Q1, Q2 next year. As the move recently has been so quick that companies haven't had the time for that to flow completely through the income statement. Look, what we're telling companies and what I spend most of my days doing is to give people advice around, strong dollars probably here to stay. I think you summed it up correctly, which is, when you think about your alternatives, the UK, Europe, Asia, the U.S. continues to make a ton of sense in terms of where people want to keep assets going forward.
So, Joseph, you said it that you're implying things are going to get worse because the dollar keeps on going up and there's a delayed effect. This is what companies do, right? They hedge currencies, whether they're going up, they're going down. This is part of their operations. As you said, you help them do that. What is it about this current environment that is so tricky for them? Is it the speed of the move in the dollar, the persistence of it? Is there something unique about this point in time?
Well, it's two parts, right? I think it's the speed, and then what you have is the persistence, right? And I think for companies, the hard part right here is, companies are hedging 6 to 12 months out. They're managing, for a year at most, 18 months for the companies that are a little bit more aggressive. And so the decision to make is, if I go and hedge now, do I lock in what is potentially a problem that may bounce back, right? And so the hardest part for companies right now is to really determine, will this persist? And when you have this discussion back and forth about there's going to be a recession in the U.S., which probably could mean the dollar could weaken, it's hard for companies to make decisions, right? Like, you can take 10 economists, and you've probably had 2 or 3 people on, they'll say slightly different things, have slightly different forecasts. And I think that's been really challenging for my clients is sort of, there isn't a consistency in view. And a lot of times the views have changed so rapidly, right? 6 months ago, the view was very different than it is today. And so, and sum it up, I think it's just hard for companies to make decisions in this market when you have this much volatility and, the outcome is so determined, really not by fundamentals, but really by policy.
Joe, what sectors are doing a good job of hedging in this environment?
Well, it's funny. I would say, I wouldn't say some sectors. I think it's the size of companies that are doing better. The larger companies just have much more developed policies. They're just doing more. They've got a history of hedging. They've just been global longer. I think it's the new companies that over the last 5-10 years have seen rapid growth. That growth has been faster than their ability to put policy in place, right? So, I wouldn't say it's a sector, right? I would say companies that are seeing, have seen meteoric growth over the last 10 years are probably a little bit behind the 8 ball. The companies that have been global for 10, 20 years tend to have policies and tend to be managing FX already. Smaller companies are also a little bit troubling, right? Because for them, they're still growing, right? And you kind of want to grow and then have hedges in place. So I would say, companies that are big and have grown rapidly recently and smaller companies, those are the companies I probably worry the most about.
And so with the size of those companies that you're really studying across and researching around, it also comes down to their employee base in all of these countries too. What role does the workforce, the employment and the wages across those different entities, what does that play as well in some of the FX considerations?
Look, if you can have earnings and costs locally, that's your best outcome, right? So if I can sell my goods in a country and hire locally, that gives me cost to offset revenue. The companies that have the most issues will tend to be companies that have a lot of intellectual capital in one country and then sell goods in the other. So think about tech. Well, if all your programmers are in one country, but you're selling goods globally, you don't actually have cost to offset. So companies are starting to think about that, right? How do I create natural offset? Where do I want to have my labor force, capital to offset some of my FX risk? That's the ideal situation. Most companies aren't set up that way. They tend to have what you tend to find, and you look in the tech sector, you tend to have a lot of costs in the US for the US companies and a lot of net income overseas. And so that's always a challenge.
Joseph, bottom line, what do you think the magnitude of the effect of stronger dollar is going to be in terms of the hit to U.S. corporate earnings?
Look, I get the benefit, I would say, of not having to look and try to estimate that. The answer is hard. That's a very hard question because companies manage. And when you think about the market, right, the largest companies that dominate the S&P and the Dow, they have FX policies in place, right? And so I think overall, it's probably bigger than people are going to expect. And companies will come out and tell you, they'll say on a constant currency basis, we are X. But I wouldn't have an exact number. What I would say is I do probably, if this persists into next year, that it's probably going to be larger than people expect.
Good analysis here. Joseph Lewis, Jefferies head of corporate hedging and FX solutions. Have a good rest of the week. We'll talk to you soon.